Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one actively managed member of our list of 72 favourite funds, namely Artemis European Opportunities. The lead fund managers are Mark Page and Laurent Millet, and between them they've over 30 years investment experience. Their mandate is to generate long-term capital growth from their £364 million portfolio of stocks, which principally hail from Europe's stock exchanges, excluding the UK. Their focus is on high-quality stocks, but only those that come at a reasonable price, though I should say that the fund managers are not wedded to any one investment style, as they try to generate consistent, though not aggressive, outperformance of the market over time. The portfolio is built bottom-up, and Page and Millet keep things pretty tight, holding no more than 60 names in their portfolio at any one time. As I sit here, the largest portfolio positions include German chemical and life sciences giant Bayer, Swiss drug developer Novartis, German software player SAP, Scandinavian financial services specialist Nordea, and Danish pharmaceutical stock Novo Nordisk. By sector, financial services, industrials and healthcare are the three biggest sector exposures at 20, 19 and 15% of the portfolio respectively. That's over half in total. By contrast, there's a 1% weighting towards energy, just 2% in utilities, as we can see here. To provide a little bit more context, the biggest underweights relative to the benchmark index in the fund are energy, banks and consumer staples, the last named on valuation grounds. Now by country, France, Germany and Switzerland are the three biggest exposures. Large caps overall currently represent just over 60% of the assets, mid caps just over a third, and small and micro caps just under 5%. The fund is eligible for SIPs, ISAs and dealing accounts, and currently comes with a relatively lowly historic yield of 1.4%, which I guess is primarily the result of the focus on capital growth. That said, Artemis European Opportunities does come with income units, where dividends are paid out, but on this occasion we're discussing the accumulation units, where the dividends paid are automatically reinvested for you. Now, the ongoing charge figure is 0.85%, so you do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. Okay, those are the mechanics. The question to address next is why could investors consider this collective for portfolio inclusion today? And I think there are three perfectly possible reasons. The first is that Western European stocks are doing well. The Eurozone economy continues to surprise on the upside, unlike that, say, of America, where President Trump is making more progress on Twitter than he is getting legislation through Capitol Hill. As we can see here, in sterling total return terms since January the 1st, Western Europe is the second best performer of the major geographic regions, lagging only Asia ex-Japan, and beating the UK, US and Japan actually pretty handily. Second possible reason to look at European stocks in this fund is the European Central Bank, which continues to move heaven and earth to keep the Eurozone project on the road. Under President Mario Draghi, the central bank seems in no rush to raise headline interest rates from zero and continues to run a quantitative easing scheme that runs to 60 billion euros a month. Low returns on cash, low yields on bonds are driving investors towards stocks, just as we saw happen in the UK, US and Japan. The third reason is the fund's own performance. This chart shows performance since inception in 2011, and the last 3 years' returns are good enough to rank the fund in the top quartile, or top 25%, out of a field of over 120 odd funds. Now this is not to say Artemis European Opportunities will suit every investor. The absence of a yield may put some off. The role of the European Central Bank is a current source of strength for the European equity market, but that obviously begs the question of what would happen if Mr. Draghi were to turn off the monetary taps and end the QE experiment on schedule in December. And also note that the euro started to strengthen, especially against the dollar. A really strong currency could actually start to dampen European earnings growth and potentially crimp stocks' performance as a result, especially as they've already done so well of late. For our final graphic, we can see, for example, that Germany's DAX index has already slipped to a 3-month low amid such concerns. So, investors must therefore do their own research on Artemis European Opportunities to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital at risk. So thank you for watching. and I look forward to seeing you next time.